Alrighty, I'm gonna go ahead and record this, and I'm gonna go ahead and record this, and testing, yeah. All right, so June 25th, I'm gonna do a trade recap and then just address a few things that I've used in trading, like a quick teaching webinar, as well as a recap for today's trade. I'm gonna be discussing futures, NAS. So let me get started. Again, I'm recording this, so even if no one's in here, I'm still going to record it, and hopefully members will watch it at a later time. So this is the NASDAQ. I trade futures. This is TradingView. So I'm going to go over trade recap for today initially. and then we'll discuss the other topics. So if it's not clear, we're kind of in a bearish move here. If you're the type of person, hold on, let me move it. There we go. All right. We're in a bearish sentiment here. Why are we in a bearish sentiment? Because we have a high here, a lower high, and a lower high. Even if you go by the wick, this is either almost equal highs, it looks like, or maybe this is slightly lower. Either way, we had a high here, a lower high, so we're kind of in a bearish sentiment. And for today's trade, obviously, if anyone saw the meltdown that NASDAQ took this morning, wondering if we were supposed to expect that or not, we kind of were. I wasn't prepared to take this trade. I did scalp it on my prop firm, but not on my live because I was doing a few things. So I'm going to get into that trade. And I'm going to also kind of get into my strategy that I've been using here. So initially, I like to be on the 15-minute. And you see this long drop here that happened today. For my trade recap, I'm going to recap it the way I normally take a trade. That way it makes sense and it flows naturally. So initially, I like to look at midnight. And I'm going to change that color. So this is midnight candle here. I like to look and see when it opens. I'm just doing for anyone who's chimed in, I'm doing a trade recap real quick. And then I'll go over the other topics. So I go over, this is midnight. I like to look at the midnight candle and look at what price does. Somewhere in the London session between 2 a.m. and 5 a.m., we get this high mark right here. I'm going to put this on there. All I'm looking for, by the time 8:30 hits, okay, because 8:30 is usually historically when news tends to hit, at least in the morning. Not that we had news, but this is the appropriate time to kind of look, right? Because the news embargo is what opens up. Oh, actually, we did have news. Shoot. Okay, I didn't even pay attention to that. So actually, I did, and I forgot. So GDP came out, core, all of this, and then we had some orange folders come out, unemployment claims. So this price, London, this is where it hit the highest. This is when news embargo released. And if I move this red line, you see that price went above the highest part of London. Not paying attention to what happened during Asia because London, obviously, a lot higher price point. And here by 8:30, price went up and took out this high. So initially, the reason why I point this out is because initially my bias was bullish. Why? I saw this big move that happened the night before. That was one reason. There's a fair value gap right here. There's a fair value gap here, another tiny one here, big one here, here. There are points where price could easily come to. Sometimes it's nice to look at price in a bigger flow. And let's say we can't see this part. Let me put this on a replay to just say, hey, let's say we can't see what happened in London. Let's just only focus on here. And if I focus on here and I see price came out and took out this consolidation here, took out that most recent high, change directions, or break a structure, or change in market structure, whatever terminology you use, my mentality was, hey, we're going to come up and take all these highs. And we have things to draw us into it, fair value gaps. We have draws on liquidity up here, minor ones, even on the 15-minute that I'm on. That was my expectation. So the fact that we did not do that, let me take out of market replay. And what happened was price kept making higher highs. The other thing is that typically in London, whatever London will do for the most part, New York will sort of follow through. Because London will show you a little bit of manipulation and then the true direction, which if I'm measuring from here, 20 o'clock or 2000 here, Asia came down, it got low, its lowest point was here. London did not get any lower than that, but it certainly got higher than its highest point, which is right here at 2000. And so there's obviously a manipulation that takes place, and the manipulation actually ended up taking place in New York and not in London. So that's one way to look at, liquidity manipulation taking over. The other way to look at it is typically Asia likes to accumulate, London likes to distribute. It likes to spread out wider. So typically London will take out Asia's highest or lowest point. It likes to distribute and show manipulation. And typically New York will continue that distribution. So it's usually accumulation in Asia, manipulation in London, distribution in New York. So that's another way to look at price and using that to figure out what your bias could be. For me, like I said, it was bullish prior to all of this. I wasn't paying full attention to it. But when I came back and looked at the market, I saw that London made this high, and right at 8:30, price took it out. This is a form of liquidity where price would want to come up and trick everyone who is bullish because, hey, they've been bullish since this night, right? They've been thinking price is going to continue, but not paying attention to this key level in London and seeing that price actually came up and reversed out in the opposite direction. So I can drop into a smaller time frame. This is the 5-minute. And again, the same thing, takes out this London high up here and starts to trickle down. And if you're a fair value gap trader, or if you're a support and resistance trader, you could say, hey, I have some resistance here and I have some resistance here. It's not perfect, but I do have some resistance here. Maybe price wants to go down. If you drop down to a smaller time frame, and I think it was the 1 minute that I saw this, if you pay attention to these, you can notice that this are relatively equal highs, but there are strong draws on liquidity, which means relatively equal highs which is what a support and resistance trader would call strong support, or excuse me, strong resistance, right? Price came up here, it came down, it came up here, it came down. Typically, somebody would trade this and go, yeah, we're going to go down. Someone like myself who trades liquidity and looks at sessions and data ranges, when you see this area of relatively equal highs, not price hitting just once, but twice, price is going to eventually come back to that. And it's going to either take that out or go up. So here, price took it out, swept this high, meaning it got higher than this highest point in London. Again, this is the same high time that we saw in London, just on the 1 minute, and price started to reverse. So give me 1 second. Let me see if okay, cool. So price took out this high and started reversing down. So again, if you're a support and resistance person, you use this red line here. Look at it as resistance, as your reason to trade this downward. For me, I looked at this and said, I have to look for liquidity. I have to look for displacement, and I have to look for fair value gap. Here, liquidity was taken out with this red line. Price went up and came underneath it. But I need to see a swift price move. And this is where I bounce around between the 5-minute, 3-minute, 2-minute, 1 minute until I see what I'm looking for. And right here on the 3-minute, price with this displacement here, this is a nice strong candle that's come underneath this swing low. This is a swing low. Price came down underneath it. And then with my box, I draw, this is a fair value gap because there's a gap between this first candle and a third. There's a space, and price rallies in, doesn't leave a body above it, but leaves a wick, which is cool, and displaces aggressively downward. This is my signal that price was going to go down. Let's say if I missed it, if I didn't catch this trade right here, which would have been perfect, this would have been at 9:30, literally 9:30 at market open. Let's say I didn't expect that to happen there. I can go down to a smaller time frame and look to see if I have another entrance. This is a nice move of a candle. However, I don't see that price barely went into it. What makes a fair value gap really nice and strong is when a candle goes kind of hits at least halfway in between this box. It's hard to see this square. There's a yellow line right here, and this candle goes through, comes out. So if I use this box here, I wouldn't have relied on it as strongly because this candle barely goes in, it almost just taps. It doesn't show any respect or acknowledgement of this gap here, so I wouldn't have used that. What I ended up using, because I definitely wasn't paying attention, like I said, I was doing a multitude of things. And Thursdays, if anyone ever notices, Thursdays tends to be a melt day. It not always, but if there's ever a day where price tends to melt, it's mostly on Thursdays and then sometimes on Fridays. So once I saw this candle move, I said, "Oh yeah, we're booking." And once I started to see this, I saw that as well. If I scroll down here, I could see this is another opportunity to enter. This is a fair value gap. I see that this candle wicks into this space and pushes down. Now you might say, well, that's not much because by the time it goes down here, it starts to reverse. Well, that's fine because that's a good 2 minute, 4 minute, 6 minute, 8 and 10 minute move. And you can make significant money depending on what your trade is like. So this fair value gap coupled with the fact that it's a huge displacement that could have given you 10 minutes move. And that's the trade that I took here on my prop firm. So I wanted to go over that trade recap there just to show that looking for tomorrow, if I go back on the daily, refresh this, I wouldn't be surprised if price tries to come down a little bit lower here. Right now, we have this fair value gap right here. Let me remove my drawings. We have a fair value gap right here between these two spots. Price has already been in this space, so I would not be surprised if price wants to show reflection down further here, even aiming down to this lower section. If not, it may still come up upward. There is no more inefficiencies right now because all the candles are overlapping each other. But obviously, following wherever price is currently, as we're looking at it at 9:14 Eastern, price has opened up here, done a fake up, and now it's pushing downward. But I don't start to look at what the bias may be until the midnight price opens and basically New York market opens, which is around midnight. And that's when I start looking at what London does to manipulate Asia, which will let me know what New York looks like. Okay, so that's my trade recap. Now I wanted to go into what I mentioned in the title, which is BPR, which stands for Balancing Price Range. And it's basically this whole model right here. So I've seen it a lot in other videos, and I've obviously seen it a lot in trades, but I've never really paid attention to this trade until I entered into the trade. I realized this was a BPR. So a BPR is basically this move where price moves swiftly in one direction, swiftly, and it has to be like this clear, right? Like upward candles only. It's moving in almost one straight line, and it kind of teeters off and maybe consolidates or does whatever it does in the middle, which is interesting because it makes sense that it would do this between 1800 and about 8:30, right? Because nothing's happening between Asia and London, not anything significant anyways. So it does nothing here, and immediately as market opens, which is right here at 9:30, you get this and it's 15-minute price, 15-minute chart. You have this really large candle come down. So what it's doing, it's mirroring what happened. I've said this before, but I have no problem saying it again, is that price always comes back to itself. Imagine price has climbed down here. It's not just going to keep going straight. Notice how price comes back up. It's almost mirroring where it's been. It's almost using its previous placement to bring it back in order for it to continue back in the favored direction that it wants to go. And again, for it to go down, it's going to use where it's been. So I've used the term price is magnetized to itself. It's gravitating to itself. It never just moves on its own. It moves in accordance to where it's been. That's how price moves. So here we have price moved upward. It kind of had this, jagged look. And then what does it do? It comes back down to where it's previously been. This almost acts like a draw on liquidity or a liquidity pool or void where it has to come and fill. And then guess what? This is another liquidity void that price is eventually going to come into and fill. Now, it's obviously based on this image here. It may not come back up straight and fill it, but it will at some point come into it. So whenever you see whenever you see an image like this, you just see this nice, swift, straight move, be mindful at some point, usually in that 24 hours, if you're opening in New York, where we know New York has the highest volatility, the most movement, the biggest volume, what's not to say it won't come back and fill this? Now, if we're looking at the time of this happened at the end of the day. So after central bank, what's it? I forget the abbreviation, CBPR or something like that. Central bank time ends at 3 p.m. New York time. So right 15 minutes afterwards, when we start to get this big move, and I didn't even look to see if we had news that took place yesterday at that time to push it. Well, Trump spoke, but that was at 8:30 p.m. apparently. Um, so that was he spoke 3 hours after this took place. So this took place here, this swift move. So in less than 24 hours, almost in 18 hours, I guess, price um, shows this move down. So that's just a little something to leave. You don't have to trade that, or that doesn't have to be a specific type of trading strategy necessarily. I think it's just a nice tool to have in your brain or in your head when you think about trading and how that works. So I kind of like that move there. Okay, now I'm gonna go over premium versus um, premium versus discount, and using Fibonacci retracements to decide that. So I'm gonna go back on the daily. You can have this can happen on any single time. Well, maybe let me just do on a 15-minute because 15 minutes are nice. Let's say we want to trade, right? Typically, when you want to trade, this yellow line here is considered a 50% line because it divides this entire box in 50%, right? It divides it in half. The same goes for, what do we call the top part of this box? Is premium. Imagine numbers are higher up here, and imagine down here, numbers are lower. Okay. So if you think about the number 0 down here, and if I put up here the number 100. So what am I saying? I'm saying that numbers move from lowest to highest. So the higher you go up, the higher the numbers are. Same thing with our pricing, right? When we see price being up here, we know that the price is a lot higher than if it was down here. It's been a lot lower. So price likes to move from one space to the other. Again, thinking about how I drew that arrow, price moves from up here to down here, but it's going to do it in a step-like manner. Okay. And it's not going to be perfect because I'm just doing it off the cuff. But you'll notice that if you take a box, and now you can use the gain box here, if you take it from the top, this first move up to down here, let me adjust this. Huh. Okay, there you go. I'm gonna mark this as red. You can barely see that, so I'm gonna make that darker. Interesting. You can barely see that for some weird reason. Okay, I'm gonna use a different line. So I'm gonna go ahead and use, you can't see it, but I'll just draw this quickly. There's a red line right here. I need to zoom in so you can see it. It's very faded. There's a red line right there. This red line represents halfway. Yeah, I'm not drawing this perfectly, but it's halfway. It's to show that price will come down or go up. And since it's wanting to go downward, it's going to first retrace upward, right? Because we said price must retrace before it goes in the direction it wants to go in. And again, price never moves in one straight line. Price moves in a step-like fashion. But the question is, when it retraces, how far up does it retrace before it goes down? This is the equilibrium. This is what is described as equilibrium. When price comes into that 50% space, before it goes down into the space that it needs to go into. So we look at it at being at 50%. 50% mark. Price is going to come up halfway of the initial move before it goes downward again. So if we come back up here, and I'm going to draw the white line so you can see it, from price moving up here all the way to down here, and this is not perfect because price doesn't always do this, but ideally it's going to come 50%. It's going to come up halfway of this first downward move. It's going to come up halfway and then returns back. It's going to come up halfway and then go back down. Ideally, that is how price moves, ideally. So what does that mean for us when we're trying to take a trade? If we're trying to take a trade, or how does that mean for price when price moves with the market? Price will always never, just like you and I, when we go to the store, we always look for a discount. We never just go for the expensive item on the shelf, the first thing that we see that catches our attention. If we're smart about shopping and if we understand how the market is and money works and what discount is, you'll never just walk into a store, which I'm terrible at drawing. You're never just going to walk into the store and see the first thing that you see. I can never draw properly. Yeah. And say, hey, I'm going to go right for the expensive thing, which is premium. You normally are going to go for what's cheapest, which is down here. The lowest thing. Like if you ever shop for wine, if you notice that some of the cheaper ones, or maybe the less quality ones, but a lot of the cheaper ones tend to be at the bottom. It's a lot cheaper. So you tend to go for the discounted price before you ever consider the premium. Well, price does this too, both upwards and downwards. When price moves in one direction, it's always going to move where it can get lowest discount before it moves back in an upward direction. That's how price tends to move. What does that mean for us? That means anytime we're looking at a price and we're looking at a range, like let's say we're ready to trade and we look at this range and we're interested in getting into this trade later on here, we're going to use a Fibonacci retracement and measure the highest point to the lowest point of where we see price and use that as a place to gauge where price may change its direction. So price has gone from up to down, right, in its full form. And we know that 50% is the halfway mark for price. So if price is in this discounted space, and I'm just going to reiterate it, show it here. Like say price is down here, we expect price to do what? To come up to this 50% line. Let me say price is down here. We expect it to come up to this 50% line and show us that it wants to keep going downward. Or we expect it to come up to this 50% line, move around, and then show us it actually wants to change direction and start going up. But typically, if our expectation is that price is going to go down, then we know ideally we expect price to come up to this 50% line, maybe a little bit higher, maybe just tickle around it, and then do what? Go back down. Not reach here, but go further downward. That's the idea. So ideally, you can take a trade from right here all the way down to here and get a good amount of money, knowing full well the price is going to come here to this point. Whether it continues downward, that's whether you want to leave a runner on there, sure, especially if you expect price to keep going down. But this could be a nice scalp or honestly a full trade depending on how wide you trade this. So looking at this drawing here, I took that Fibonacci drawing up here and I have settings on it. Hold on. Everybody has different settings, but these are the settings that I've used on here. And when you draw it from the top of this candle to the bottom of whatever range you're looking at, you're going to look for that halfway mark. And what you're waiting for is for price to reach to this point and show you what it wants to do. So price reached here and it kind of reversed back down. Then it came back up here, kind of tickled around. It never showed a true direction of where it wants to go. But what happened? It started to reverse back down. The price started to reverse back down, and of course, down into this BPR that we see here. So eventually, price could continue going back down. We don't know, but at least in this Fibonacci drawing, we've utilized it to show that price wants to keep going down just based off of this move that we're seeing here, that we've marked here. I don't know about the future, but I know for now, if we took this trade, let's say we drew this Fibonacci mark, maybe even if we drew it out to, yeah, if we drew it out to from the highest to the lowest, we would have waited for price to reach this mark here and then wait for it to show us that it wants to reverse back downward. Even if we look at this price movement here, we take that same Fibonacci tool, and you're going to do it in the direction in which you are creating. And you're doing it for the most recent high and the most recent low, because everything that you do, all the confirmations, the confluences that you use when you're entering into a trade or getting out of a trade, you want to focus on immediately what's happening and then keep in mind what's happening later on. So, like I've mentioned before, in my mind, I know that there is a fair value gap. There are fair value gaps up here that price could eventually come up to. And I should say that I know that there are areas of liquidity here that price is drawn to. So price can go either way for me. I keep that in mind in the back of my head. But wherever price is right now is where I'm going to focus on my other tools like the Fibonacci. And I'm going to say, this is my highest point here. And you can say this is your lowest because right now you're in a rangy position, right? Drawing this Fibonacci from the top to the bottom here, this is our red mark here, the 50%. And I see that price is kind of ranged here. It's not shown any clear direction. I'm not even sure I would take this as a clear direction yet because it's been here before. It's been here before. It's been there prior. So this is a great way for us to figure out, do I want to take this trade or not? By giving me, where do I think price really wants to go? It looks like price wants to keep going downward. It looks like it does, just based off of this image. But when I calculate time, because this is about 2100, and I calculate volume and I look at this being very rangy, I don't see myself entering into this trade for those few reasons. I see it respecting this fair value gap, which is great. So yeah, another reason why I think price may come down and aim for these areas down here for Friday. But I wanted to explain the Fibonacci tool, and I wanted to explain premium versus discount because I used it pretty regularly, and I wanted to explain what those look like because those are really great confluences or tools to use without having to rely on indicators to help you determine where price is and where it wants to go. We can look on the hourly, and I can scoot back here. If I wanted to take a trade, let's see. Yeah. Let's see, actually. Okay, leave it like that. So whenever you want to take a trade, and let's say market's going to open up right here, and you're trying to figure out what your trade is going to look like, you want to look at the most recent high to the most recent low. For this particular trade, you can always do a wider view of price. I can do a higher view of it here, but I know that it's either going to take longer and it may not reflect my immediate move right now for a trade. But it's important to know that when you're looking using Equillibrium, you want to look at the most recent high and the most recent swing high and swing low. So when I take this Fibonacci, I'm going to put it at the body of this high, and I'm going to put it at the low of there. And so I see that this red line is up here. So if price wants to keep going down, it's going to have to show me that it's going to hit this red line and start showing me signs it wants to go down. So let's see. And realistically, if you're a scalper or you don't really have time to trade, but you want to enter into a trade, I see this fair value gap right here. I could enter into this trade because I see price is giving me this nice large movement up. And this is on the hourly, but just saying nice movement up with this fair value gap respected. I could possibly enter into this trade, put my stops here, and aim for this smaller swing high or aim for this initial swing high that I have up here. But realistically, this is 2000. time. So you have to be mindful that you may not get the full range because Asia is an accumulation session and you're not always going to get a huge move. And again, these are the hourly candles. And to be realistic, price entering into this gap is great, but when I look at these kind of relatively equal highs and how their bodies are sort of respecting each other, I may have gotten out after this candle or so. But again, this is a Asia session, which doesn't always give you the best move. Let me keep clicking through. Okay, so price hits that red. So again, you could take in this trade with this candle here or endure the fact that price came into this. And again, if you're new to fair value gaps, candles entering into this space and staying here is still respecting the gap. So you could have still stayed in this trade. Again, keeping your stop loss here, keeping your take profit here. So now this is the part where you go, okay, price has hit this equilibrium. And as you're looking at this candle, I don't see a body over it yet. So just as this candle forms, this is a good idea for me to get out of this trade. This is a good profit. Again, these are the hourly candles. So you've been in this trade from about from 9 p.m. to about 9 p.m. on a Sunday to about 11 a.m. on a Monday. Um, Hitting this equilibrium, you could say, look, I'm definitely gonna just get out because that's enough for me. Or you could say, hey, I didn't take that trade. Now it's 11 a.m. on a Monday. Now that price has hit this equilibrium, I want to see if it's going to respect it and keep going down, or is it going to cross over? And if that's the case, then it's going to show me bullish sentiment, and I'm going to look for a trade to go up here. Okay, so you see price starts to come downward. We can see how it respects that equilibrium space at some point. Okay. And so just to show that it wants to keep going, it's respected, even though it came back up to this space, it still came downward, headed in the direction that it wants to be, to showing us that it actually wants to be bearish. So I hope that's easy enough to understand. I didn't want to take too much time for anybody, but I wanted to explain those few things: equilibrium, Fibonacci, and the BPR. These again are tools in your tool belt that you can use to enter into trades that really do help you figure out what price is doing and kind of helps you get a better understanding so you don't feel like you're just entering into a trade blind and you don't know what's going on. So I hope that helped.